Have you ever felt like the traditional financial system is, you know, deliberately rigged against you?
Oh, I mean, I think a lot of people feel that way.
Right. Like if you are listening to this right now and you've ever run your own business, you probably know the exact feeling I'm talking about. You work tirelessly, you're smart with your strategy, you take all the legal tax deductions available to you, and then, well, you walk into a bank to get a loan for an investment property, and they treat you like you're completely radioactive.
Yeah, totally radioactive.
Exactly. They look at your perfectly legal, highly strategic tax return and basically tell you that you don't qualify. So, welcome to the deep dive. Today, our mission is to unpack the rapidly evolving landscape of alternative real estate financing. And we have a stack of incredibly revealing sources for this one.
We really do.
Yeah, we've got internal business plans, legal governance documents, a really fascinating marketing playbook called the Borderless Investor, and verified customer reviews from a Florida and Texas licensed digital mortgage brokerage called Mortgage Today, LLC.
It is quite a collection of documents to go through. And, the overarching theme we're going to explore today is how self-employed entrepreneurs, investors, and, well, digital nomads are completely bypassing those conventional banking walls.
Right.
They are finding ways to build scalable, borderless wealth using a completely different financial architecture than what most of us grew up learning about.
So let's start with the root of the problem. If you're sitting at home wondering why your bank told you no last week, our sources actually lay it out perfectly. According to the Borderless Investor Playbook, there are what they call the four walls of conventional lending.
Right, the four walls.
Yeah. So wall number one is the DTI, or debt-to-income ceiling. When you apply for a standard loan, conventional lenders cap your total debt obligations at around like 43 to 50% of your income.
Which is a huge hurdle for investors.
It really is, because as you acquire more rental properties, your debt load just goes up on paper. And eventually the algorithm simply cuts you off, regardless of how well those properties are actually performing.
Well, the underlying issue there is that the conventional system just isn't built to scale with a portfolio. I mean, it is designed for someone buying one primary residence, maybe a vacation home.
Yeah, it's a very narrow box.
Exactly. It treats every new mortgage as a dangerous liability rather than, a potential revenue stream.
Which brings us to wall number two, which is the tax return trap. And this is where it gets incredibly frustrating for successful people. Smart investors write off expenses. The sources specifically mention strategies like cost segregation.
Oh, cost segregation is a big one.
Right. And for those not deep into real estate accounting, cost segregation is basically a way to accelerate depreciation. So instead of writing off the value of a building over 27.5 years, you hire an engineer.
Yeah, to separate everything out.
Exactly, to separate out things like carpets, fixtures, and appliances, and you write those off in 5 or 10 years. It saves you a fortune in taxes because it creates massive paper losses. But when you hand those tax returns to a traditional bank, you just look broke.
Yeah, you look terrible on paper.
Right. They only want to see standard W-2s, the typical U.S. employee tax forms showing a steady high salary.
You've highlighted a massive systemic contradiction there. I mean, conventional lending systems were designed fundamentally to reward personal income. They were built in an era of salaried employees with steady, predictable paychecks.
Right, the whole corporate ladder thing.
Exactly. But investment lending, like true portfolio building, relies on a totally different paradigm. It rewards property cash flow. So for the self-employed investor, these traditional rules act as a structural cap on wealth creation.
A structural cap.
Wow. Yeah, because if the system demands high personal taxable income to approve a loan, but your wealth strategy requires minimizing your taxable income through, legal deductions, you are entirely trapped by the system's logic.
A structural cap on wealth. That actually perfectly describes wall number 3, too, which is the 10 property wall.
Oh.
Fannie Mae and Freddie Mac basically cap most borrowers at 10 finance properties. Full stop. And for anyone unfamiliar, Fannie Mae and Freddie Mac are the massive government-backed entities that buy up the vast majority of mortgages from local banks in the U.S.
They essentially write the rule book that all the local banks follow.
Right. So why do they cap it at exactly 10?
It comes down to institutional risk modeling. From the perspective of a government-backed entity, Once a single individual holds, say, 11 or 12 mortgages, they are no longer viewed as just a mom-and-pop homeowner.
They're a business at that point.
Exactly. They are effectively operating a commercial enterprise, but because they are applying for residential loans, they aren't subjected to commercial underwriting standards. So Fannie and Freddie simply draw a hard line at 10 to prevent individuals from building massive, highly leveraged commercial empires using government-subsidized residential interest rates.
Okay, let's unpack this for a second. The bank is essentially looking at entirely the wrong metrics. It's like, I don't know, it's like being judged on your marathon time when you're applying for a weightlifting competition.
That is a perfect analogy.
Right, like if I'm an investor, my personal W-2 income really shouldn't matter if the asset I'm buying pays for itself. And that disconnect is even worse for wall number 4, which is the 4 national lockout.
Oh, that one is a brick wall for a lot of people.
Totally. If you are an international buyer, you don't have a U.S. credit footprint. You don't have a U.S. Social Security number. So traditional banks just refuse to play ball entirely.
Which is exactly why a parallel financial ecosystem had to emerge. I mean, what's fascinating here is that if personal income and U.S. credit history are the wrong metrics for these investors, the industry just had to develop alternative metrics.
They had to pivot.
Right. This is where we see the transition away from the individual borrower and toward the asset itself. The sources point to 2 main tools acting as the engines of growth for this strategy, with the first being the DSCR loan.
Yeah, I found this concept so fascinating. DSCR stands for Debt Service Coverage Ratio. And the math on this is actually brilliant in its simplicity. It completely strips away all the personal tax return drama we just talked about.
It really does.
You literally just take the monthly rental income of the property and divide it by the monthly debt service. And by debt service, I mean the principal, interest, taxes, insurance, and any HOA fees. So if the rent divided by the debt equals exactly 1.0, the property breaks even.
Right, simple math.
Yeah. And if the ratio is 1.25, you have a 25% profit margin.
The crucial shift here is the underwriting mechanism. The loan approval is based almost entirely on that ratio. If the asset generates enough cash to cover its own debt, the lender doesn't need to see your personal W-2s or your complex tax returns.
Which is a huge relief.
Exactly. They are loaning money to the property's income stream, not to your personal salary. And because of this, you can often place the property directly into an LLC, which further insulates your personal finances.
It completely flips the traditional banking model on its head. But, discovering this loophole is completely useless if you don't have the initial capital to get into the game in the first place.
Right, you still need cash.
Exactly. Which leads us to the second tool in the playbook, the HELOC, or home equity line of credit. But the borderless investor playbook frames this in a way that feels almost, countercultural to how most people view home ownership.
It definitely goes against the grain. The playbook uses a very specific term for home equity. They call it dormant capital.
Dormant capital.
Yeah. For generations, paying off your primary residence and sitting on hundreds of thousands of dollars in equity was considered the ultimate financial goal. I mean, it felt safe.
That's what my parents taught me.
Exactly. But the playbook argues that this equity is essentially potential energy. It's static.
Yeah.
If you have $250,000 sitting in the walls of your house, it isn't earning any yield, which means it is actively losing purchasing power to inflation every single year.
So the HELOC acts as a sort of financial pressure valve. It allows you to tap into that trapped potential energy. It's a revolving second loan, meaning you don't have to touch or refinance your primary mortgage, which is, especially important if you locked in a super low interest rate a few years ago.
Oh, yeah. You do not want to lose a 3% rate.
Never. You just open a line of credit against the equity. But here's where it gets really interesting, and I have to push back a little bit on this.
Sure, go ahead.
If I have $250K in equity just sitting there, the playbook argues it's dead money. But isn't the HELOC incredibly risky? You are literally betting your house. If the market turns or you can't make the payments, your family's home is on the line.
That is the most common critique of this strategy, for sure. And the playbook addresses it with a very strict philosophical distinction between liabilities and assets.
Okay, how so?
Well, tapping your home equity is only dangerously risky if you use it to fund a liability, meaning something that loses value and doesn't pay you, like, say, renovating your kitchen just for aesthetic reasons, buying a luxury car, or going on a lavish vacation.
Right, consuming the equity.
Exactly.
Yeah.
That is how people lose their homes. But sophisticated investors use this liquidity exclusively as kinetic energy to acquire income-producing assets. They are trading dormant equity for an asset that immediately generates cash flow, which is then used to service the HTLOC debt.
Oh, I see.
Yeah, the risk is heavily mitigated because the new asset pays for the debt you took out to acquire it.
So you're basically treating your home equity like a corporate credit line to fund acquisitions. That makes a lot of sense.
Mm-hmm.
And when you combine those two tools, the HELOC to provide the initial cash and the DSCR loan to provide the long-term non-income-based leverage, the sources outline what they call the capital mobility engine.
Capital mobility engine, yes.
It's a 6-step framework for perpetual wealth generation. And reading through it, I mean, this is really the core aha moment of the entire playbook.
It really is. It is a complete blueprint for continuous capital recycling. I think we should probably walk through how a borrower actually executes this loop in the real world.
Absolutely. Let's do it. So step 1, you open that HELOC on your primary residence to access your dormant equity. Step 2, you use a draw from that HELC to make a down payment on a new investment property. Or, in some cases, you use a massive draw to make an all-cash offer, which helps you win competitive bids.
Right. Cash is king in real estate.
Exactly. Step 3, you stabilize the property. You might do some light renovations, but mostly you just get a solid tenant in place so the property is officially generating rental income.
And step 4 is where the real magic happens. Now that the property is stabilized and producing income, you refinance it into a DSCR loan based entirely on its newly established rental income.
Right. And because you did a cash-out refinance with that DSCR loan, you take those proceeds and execute step 5, which is you completely pay off and replenish your HELOC. So your primary residence is no longer encumbered by that debt.
It clears the board.
Yeah, which leads naturally to step 6, which is just repeat.
Yeah.
Your HELC is back to full capacity, ready to be deployed on the next property, while the previous property sustains itself through rental income.
It's a powerful loop. But what elevates this strategy from a neat local trick to a true macroeconomic phenomenon is the borderless aspect.
Yeah, this part is wild.
It really is. This capital mobility engine ignores international borders completely. The playbook details how U.S. equity becomes global purchasing power, fundamentally changing how investors view geography.
The example they gave in the text absolutely blew my mind.
Yeah.
Walk me through the mechanics of the Portugal strategy they outlined, because it sounds almost, too easy.
I know, it sounds crazy, but the mechanics rely entirely on currency and interest rate arbitrage. So an investor takes a $120,000 draw from their U.S. HEOC. Let's say it's at an 8.5% variable rate. That costs them about $850 a month in interest-only payments.
Okay, tracking.
They take that $120,000 in cash, fly to Portugal, and buy an ocean view villa outright. Because they are a cash buyer, they don't need any foreign bank approvals. There are no foreign credit checks and no long waiting periods.
Right, they just buy it.
Exactly. Then they put that villa on a short-term rental platform where it generates, say, 2,200 euros a month.
Wait, really? So they're sitting in the U.S. using 2,200 euros of foreign income to effortlessly cover an $850 U.S. debt payment, and they're just pocketing the massive spread.
Yes, exactly.
And it flows in the other direction as well. The sources detail how foreign buyers are doing the exact same thing to buy up U.S. real estate. They use something called an ITM. And for those listening who don't know, an ITN is an individual taxpayer identification number.
Right. Issued by the IRS.
Yeah, it's issued to individuals who are required to have a U.S. taxpayer identification number, but who do not have and are not eligible to obtain a Social Security number.
Precisely. So a global investor from Latin America or Europe can get an ITNN and then use a DSCR loan to purchase property in Florida or Texas.
Wow.
The U.S. lender really doesn't care that the buyer has no U.S. credit score or U.S. employment history. As long as that Florida property generates enough rent to cover the DSCR ratio, the global investor can build a dollar-denominated portfolio.
That is a staggering realization. I mean, if you live in a country with a highly volatile currency, parking your wealth in U.S. real estate via an ITN and a DSCR loan is basically the ultimate hedge.
It is about strategic geographic diversification. Investors are hedging against inflation, currency fluctuations, and political risks in their home countries. And in many cases, they are using these cross-border cash acquisitions to gain second citizenship or permanent residency.
Oh, like the golden visas.
Exactly. The sources specifically mentioned the Golden Visa programs in Portugal or Greece, where buying real estate actually grants you legal residency. I mean, this level of capital maneuverability and global citizenship used to be exclusively reserved for the ultra wealthy, like the top 0.1%.
Right.
Now it is totally accessible to upper middle class professionals with home equity.
But, understanding the theory of borderless capital is one thing. Actually executing it requires an entirely different kind of financial infrastructure. I mean, if I walk into my local neighborhood bank branch and tell the teller I want to use an ITI to fund a DSCR loan for a Portuguese golden visa
They
strategy,
could look at you like you have two heads.
exactly, they would have no idea what I'm talking about. Traditional banks simply don't have the systems or the mandate to process that.
Which necessitates a completely different type of institution. And that brings us to the operational documents of Mortgage Today, LLC.
Yeah, let's look under the hood of this company. According to their business plan, it was founded by Kevin Rodriguez, and the documents explicitly list his NMLS number as 1959152.
Right, and NMLS stands for the Nationwide Multi-State Licensing System.
Exactly.
Yeah.
It's the federal database that tracks and licenses mortgage professionals to ensure they are legally authorized to do this work. Anyway, the background story of the business plan is fascinating. Rodriguez spent over 7 years living and working abroad across 5 different countries as a digital nomad.
That's a lot of travel.
Yeah, and the documents state that experiencing the massive friction international buyers face trying to get loans directly inspired him to carve out this specific borderless mortgages niche.
His approach to solving that friction relies entirely on a decentralized, digital-first structure. Mortgage Today does not operate like a legacy bank. There is no massive vault, there are no marble floors, and no slow-moving, centralized lending committee.
Right, no stuffy boardrooms.
Exactly. Instead, they operate as a digital broker plugged into a massive secondary market. They have a network of anywhere from 40 to over 200 wholesale lenders, including industry giants like UWM, which is United Wholesale Mortgage, the largest wholesale lender in the United States.
And because they are just a digital node connecting borrowers to hundreds of specialized wholesale lenders, their speed is outrageous.
It really is.
The visual evidence in our sources includes marketing screenshots celebrating this. There is one showing a bank statement purchase, which, by the way, is another alternative loan type that was cleared to close in 7 days.
7 days is incredibly fast.
I know. Another screenshot shows an investor DSCR loan fully cleared in 13 days. In the real estate world, where traditional banks take 30 to 45 days just to process paperwork, closing in 7 days is a massive competitive advantage. It practically makes you as competitive as an all-cash buyer.
It does. Yet despite that aggressive speed, their internal marketing and compliance rules are surprisingly rigid.
Very rigid. I read through their brand guidelines, and they strictly forbid their loan officers from ever using phrases like guaranteed approval, lowest rates, or free money.
Yeah, the regulators would shut that down instantly.
Totally. They are required by their internal compliance to use plain English and heavily lean on disclaimers like subject to underwriting approval or options may be available. So let me ask you to synthesize this for a second. What does this all actually mean for the consumer? Because looking at these documents, it sounds like Mortgage Today isn't a bank at all. They are operating more like a high-tech matchmaking service, connecting highly complex borrowers with hyper-specific pools of wholesale money.
That is the most accurate way to view their business model. They are a technological bridge. If you look at their internal recruitment material, there's a document titled The Global Producer's Blueprint. They are actively recruiting other loan officers to expand this matchmaking network. But they aren't offering a cubicle in a corporate office. They are offering 80 to 90% commission splits, providing pre-written AI follow-up scripts to handle different languages and time zones, and actively encouraging their loan officers to operate remotely as digital nomads themselves to better court international buyers.
Wow.
Yeah, they are essentially franchising the digital matchmaking process.
So they are building an army of digital nomad mortgage brokers to service digital nomad investors. That's just wild. But I have to say, matchmaking complex borrowers at high speeds across international borders sounds incredibly lucrative on paper.
Oh, absolutely.
The pitch deck makes it sound like everyone involved is minting millions overnight. But when you dig past the marketing documents and into the actual internal financials, you see a much more grounded, cautious reality for both the investors and the brokerage itself.
That's a vital distinction to make. The playbook heavily emphasizes strict risk mitigation for the investor. It explicitly advises never to use more than 70% of your available HELOC capacity.
Right, keep a buffer.
Exactly. The logic there is that you must preserve a buffer so you aren't completely wiped out if property values dip. Furthermore, when they instruct investors on how to stress test a potential DSCR loan, they don't allow for best-case scenarios.
No rosy projections.
None. They advise modeling a 10 to 15% drop in current market rent, assuming at least one full month of vacancy every single year, and always factoring in an 8 to 12% property management fee.
Even if you manage it yourself.
Exactly. Even if the investor plans to manage the property themselves, they are actively preaching against reckless leverage.
And I found that exact same cautious, grounded reality reflected in the brokerage's own financials. There is a fascinating contradiction in their business plan.
Yeah, I noticed that too.
If you read the executive summary, it has this incredibly ambitious, almost Silicon Valley-style projection, claiming they anticipate revenues exceeding $5 million in the first year. But then you scroll down to the actual detailed profit and loss statements for 2023, and it is a completely different story.
A huge reality check.
Yeah, the actual revenue for 2023 was $78,400, leaving a net profit of around $56,000.
It perfectly illustrates the dichotomy between the marketing vision needed to build a brand and the operational reality of running a lean, bootstrapped startup.
Precisely. Their projected revenue for 2024 is much more realistic, aiming for $173,600. And looking at their expenses, I mean, they run an incredibly tight ship. Their annual ad spend is completely modest, projected at around $4,700 for the entire year.
They definitely aren't burning millions in venture capital to acquire customers through massive billboard campaigns.
No, not at all. They rely on targeted, high-value networking.
Yet, despite operating on a lean budget with modest initial revenues, the impact they're having on their actual clientele is demonstrably high.
The customer proof is definitely undeniable. We looked at verified reviews, and Mortgage Today holds a perfect 5.0 rating across 46 different verified reviews.
That's hard to do.
It really is.
Yeah.
And one specific video review really stood out to me as the perfect summary of this new era of finance. A client was praising the communication speed, specifically mentioning how they used WhatsApp to talk to their broker.
Right, which is essential for international clients spanning multiple time zones.
Exactly. But the reviewer also noted how the broker secured an amazing interest rate for them, right in the middle of severe geopolitical tensions with Iran.
That single review encapsulates the entire modern financial paradigm. I mean, you have macro-level global volatility, geopolitical conflicts directly affecting bond yields and interest rates being navigated in real time via a simple WhatsApp message to a decentralized digital broker who then secures wholesale funding for a local hard asset.
It really brings the whole abstract concept of global capital down to earth.
Yes.
So if we look back at the journey we've taken today, for you listening, we've basically decoded how conventional banks put up structural walls that effectively block self-employed and international investors by fixating on personal income. We've seen how tools like DSCR loans and HELOCs bypass those walls entirely by focusing on property cash flow and activating dormant equity. And we've looked under the hood of a modern digital brokerage that operates as a high-speed matchmaker, proving that this kind of global real estate investing is no longer just for massive hedge funds. It's completely digital, and it's happening right now.
And, the systemic shift raises an important question. It's something the playbook hints at with its core mantra, which is real estate is local, but capital is global.
Okay.
If everyday domestic homeowners start acting like multinational investment funds, using their dormant home equity to buy up neighborhoods half a world away, while foreign buyers use IT-10 to do the exact same thing in reverse, what will that ultimately mean for the affordability and stability of local housing markets around the globe?